The United States has been running large budget deficits for the past 25 years, meaning the government consistently spends more than it earns on things like Social Security, healthcare, defense, and other programs. To cover that gap, the government borrows money by issuing treasury bonds. Over time, those deficits have added up to a record $38 trillion in national debt. But the real issue isn't just the size of the debt, it's the timing, because roughly 1/3 of that debt is maturing within the next 12 months. In simple terms, the government has a huge bill coming due all at once, and that means the government must issue a wave of new bonds to replace the old ones. But as deficits keep widening and debt becomes larger, investors naturally become more cautious. Some may start buying fewer treasury bonds. Others may still buy, but only if the government pays them a higher return or yields to compensate for the extra risk. Both outcomes are bad for the government. If fewer investors buy, the government can't raise the money it needs. If yields rise, borrowing becomes more expensive, which could push the deficit even higher. And if that pressure becomes too strong, that's when the Federal Reserve often steps in. They do it by creating new money and buying those government bonds themselves, a process known as quantitative easing, or QE. In fact, the Federal Reserve has already hinted that this shift may be coming. Right now, they aren't printing money to buy bonds. They're doing the opposite, something called quantitative tightening, which removes money from the system. But the Fed has signaled that this tightening cycle is coming to an end, and many economists believe that in early 2026, they may start buying government debt again. So for the first time since the pandemic, the setup for another round of money creation is forming, not because of a recession, but because the government may need help refinancing a large amount of debt. That means we could possibly see the money supply start to rise again from here, but the impact depends entirely on how fast that happens. A slow, controlled increase could support the economy and help reduce borrowing costs for the government. But a rapid spike like the surge we saw in 2021 could be followed by rapid dollar debasement, push inflation higher again, and eventually weigh on consumer spending and economic growth. For investors, that makes tracking money supply and the Fed's policy signals more important than ever.